NextEra Energy is probably one of the most discussed utility stocks out there at the moment, and the opinions of this stock are diverging quite a bit. NextEra is the largest electric utility by market cap in the US, and their renewable energy business is of unmatched size. They have increased the dividend for 29 years, making them a dividend aristocrat, and their 10-year dividend growth rate sits at 11%, which is almost unheard of for a utility company. The dividend yield also sits at a nice 3.3%, so at first glance, it looks like a great investment for dividend lovers. But over the last years, NEE has taken on quite some debt, and the free cash flow of the company has also been negative. So the big question is, can NEE turn this around and generate nice returns for their shareholders, or should we stay clear of NextEra Energy? In this video, I'll dig into the business models and the markets of NextEra Energy, analyze the strategic position by doing a Porter's 5 forces analysis, and have a look at the latest financial statements to see how they are doing. I'll also check the valuation to determine their fair value. In the end, we will see if NextEra Energy is a good long-term investment for us or not. My name is Florian. Welcome to Cashflow Maniac. NextEra Energy has the ticker symbol of NEE on the New York Stock Exchange. They are working in the utility sector and were founded in 1925. They have around 15,300 employees at the moment, and their headquarters sits in Juno Beach, Florida. Their market cap sits at $119 billion at the moment. At first, let's have a look at the total return of NEE versus the total return of the S&P 500. And here we can immediately see that NextEra Energy did underperform the S&P 500 in the total return by quite a bit. NEE in the orange line, you can see minus 20% return over the last year versus almost 30% plus for the S&P 500. In the last 5 years, the difference is not so big, but here again, the S&P 500 did outperform NextEra Energy by 60%. But we can also see that over most of the time, NextEra actually did perform better compared to the S&P, and only over the last year, we had quite a significant dip in the stock price of NEE. When we look at the picture over a 10-year time frame, this becomes even more clear. Here we can see that NEE over most of this time frame had a comparatively good performance, but over the last year we can really see we had a huge drop down in the stock price, and since then it has been traded almost on par with the S&P 500. So the reason for this weak return compared to the S&P 500 lies in the last couple of years. Over most of this time frame, NEE did actually perform better compared to the S&P 500. As mentioned at the beginning, NextEra Energy is working in the utility sector, and specifically, they are an energy provider. Their business is split into two different areas. One of them is Florida Power and Light, and the second one is NextEra Energy Resources. Florida Power and Light makes up of more than 70% of their assets, while NextEra Energy Resources makes up about 30%. When we look at the core data, we can see that currently they have 70 gigawatts in operation and a total of $172 billion in total assets. The part of FPL alone is the largest electric utility company in the United States by retail megawatt hours and also the numbers of customers. NextEra Energy Resources is actually the world leader in electricity generated from wind, sun, and a world leader in battery storage. So this already shows that NextEra Energy Resources specifically is very much focused on renewable energy. When we drill a bit deeper into the business mix of both companies, first of all, let's look at Florida Power and Light Company. And here we can see they combine conventional power plants like natural gas and nuclear power plants with renewable power plants like solar and also battery storage. All of these plants are distributed all over Florida. Again, as I mentioned before, Florida Power and Light that only makes up 70% of the total assets of NextEra Energy is already the largest electric utility in the United States. When we look at NextEra Energy Resources, they are distributed all over the US. They are not focused only on Florida, but we can really see they are active in a lot of different states here. And in this case, they are much more focused on renewable energies. For example, in their energy generation mix, we can see that wind makes up more than 60% and solar 16% of the total generated energy. So these both segments alone make up around 80% of their total energy generation already. And all of their future projects are actually also in the renewable energy sector, like wind, solar, and also battery storage. All of their new development projects, which is a backlog of 21 gigawatts at the moment, is also made up of renewable energy sources and battery storage. One of the big focus areas of NextEra Energy and FPL specifically is exactly this focus on renewable energy and also plant modernization. Here we can see that FPL alone is developing around 5 gigawatts of new solar capacity until 2025, which will cost them around 10 billion US dollars. And over the long run, they are even expecting to add 20 gigawatts of additional solar power until 2032. This focus on solar generation and wind generation in case of NextEra Energy resources helps them provide a physical hedge against the natural gas prices, which can fluctuate quite a bit. And even though in FPL's case, the majority of the produced energy is still coming from natural resources, their solar investments could already save their customers around 1 billion US dollars since 2009. So this focus on renewable energies like solar and wind is really helping them to push their prices down and keep the costs for their customers low. But not only are they working on switching their energy production to renewable sources, they are also experimenting with clean hydrogen to replace natural gas over the long run. And just 2 weeks ago, they announced the completion of the first clean hydrogen hub in Florida. Their intention with this is actually that they blend 5% hydrogen with the natural gas in the natural gas power plants to, first of all, learn more about the clean hydrogen and also to explore ways to provide lower cost clean energy to their customers. Actually, this hub was built very close to a solar power plant of Florida Light and Power, and they actually use the solar power to produce this clean hydrogen. This hydrogen is then compressed and stored and in the end blended with natural gas and used in the natural gas turbines. Even though this is still on a very small level, it really shows the focus of NextEra Energy and their commitment to change their whole portfolio over the long run to a 100% renewable and clean energy portfolio. When we look at the strategic position of NextEra Energy, first of all, I would estimate the threat of new entrants as low. As an energy utility provider, NextEra Energy is first of all working in a highly regulated market where it's really not easy for new players to enter. And the capex requirements to build up all these power plants, the electric power plants, and even on a smaller scale, the renewable power plants like solar or so, are still quite significant. So it is really tough for new players to enter this market, especially when we consider the huge scale that NextEra Energy already has. The threat of substitutes I would estimate as medium. Because of the significant entry barriers that we have here, we have only a couple of big players. And of course, these big players are fighting for market share. Because of the regulations in this energy market, the prices for energy are capped on the lower end as well as on the higher end. So the few competitors in this market basically deal with the same kind of price range. And of course, one energy provider can easily be switched against another, but the differentiations are not that high. And with a huge customer base and as largest energy provider, actually NextEra Energy has the advantage of scale in this case. The competitive rivalry in this case is medium to high. Again, we only have a couple of very big players in this market, and of course, they are fighting really fiercely against each other for market share. But there is only so much that you can do if your price range is fixed by regulatory restrictions. There is always the danger that M&A activities can shift the market in favor of one player or another. But again, the huge size and the scale effects and also the advanced technology that NextEra Energy is using gives them some advantage here. The bargaining power of the customers is very low. Basically, on a large scale, it is impossible to replace electric energy with other kinds of energy. And because of the regulated price in this energy market, the customers have no negotiation power here. The bargaining power of their suppliers, on the other hand, I would estimate as medium to high. The majority of energy generated by NextEra Energy and especially Florida Power and Light is still coming from natural gas. And in this case, the supplier of these fuel types, like in this case natural gas, definitely have some bargaining power here because there are only limited supplies available here. When we look a bit into the future, when all the conventional energy types are replaced by renewable ones, their suppliers shift a little bit. In this case, we are talking about technology suppliers, for example, the manufacturers of the solar panel or wind turbines. And especially these kind of renewable energy sources use up a lot of land. In this case, NextEra Energy is also dependent on the price of the land where they build their plants. But even though currently the bargaining power of their suppliers sits at a medium to high level, over the long run, I would expect that this bargaining power is actually decreased when we move from the conventional energy generation more to the renewable ones. So in general, the overall strategic position of NextEra Energy as an essential electricity provider is quite strong. And even though the competitive rivalry is quite high, as the biggest player in this field, NextEra Energy has the advantage of scale, and again, their focus on renewable energies and technologies definitely gives them an edge compared to many other players in this field. Also, the essential nature of this business makes it very predictable and also makes the revenues, the cash flows of this company very predictable and very even. We will also see this when we look at the financial details in a minute. If you do like the video so far, please smash the like button and consider subscribing to my channel. It's a proven way to increase your returns by at least 3% next year. Thank you so much, and let's get on with the financial analysis now. The income statement of NextEra Energy does look a bit chaotic. We can see a couple of ups and downs here, but the general trend over the last 5 years at least is still increasing. What is also very nice to see is that the net margin as well as the operating margin have also increased over the same time frame and are actually sitting at quite comfortable levels right now. The balance sheet unfortunately doesn't look so nice, and here we start seeing why many people are very split about this company. The debt on a year-over-year basis has increased quite significantly over the last years. What is interesting to see though is that the leverage of the company actually at the moment is still on the same level as we had in 2019. And even though it did increase a little bit in the years 2021 and 2022, right now it came back down and it sits a little bit above 4% debt to EBITDA. In the next 2 years, it's expected to increase a little bit again, but over the long run, the debt as well as the leverage is actually expected to decrease. The revenue of the company is actually very smooth. We have a very slight fluctuation here, but in general, the trend is definitely to the upside. And especially over the last 2 years, we can see that we really had an increase in revenue here. The free cash flow, on the other hand, doesn't look so nice, unfortunately. We can see as of today, the free cash flow sits at minus $16 billion US. The free cash flow over the whole time frame is always negative, and the trend actually points down. That means today we even have a lower free cash flow than we had 10 years ago. And this negative free cash flow actually brings us to the big elephant in the room. And that is the dividend safe, and can NextEra Energy increase the dividend on the same or similar level as we have seen over the last 5 or 10 years even? And to answer this, we should look at 2 points. The first point we have actually seen just a minute ago, and that is, even though the net debt of NextEra Energy has gone up, the leverage didn't increase by much. Of course, the leverage also depends on the EBITDA, so there is the chance that if the EBITDA decreases, the leverage will increase again. But we also saw in the forecast that the EBITDA, at least for the next 2 to 3 years, is not expected to decrease. The second point is that free cash flow is not as important for utilities, and it can't be compared to regular companies like tech companies, for example, because of the essential and therefore very secure nature of their operating cash flows. So for utility companies, it makes more sense to look at the operating cash flow. So let's just do that. Here I have plotted the EBITDA and the cash flow from operations. Unfortunately, Seeking Alpha doesn't have any forecast here, so we can only see the data up to today. And what we can see here is that the cash flow from operation actually looks very similar to the EBITDA. We also can see a definite uptrend here, and the cash flow from operations has always been positive. So if NextEra Energy earns a lot of money with their operations, why is their free cash flow negative? The explanation for this is actually very easy. We just have to look at the CapEx of NextEra Energy, here plotted in the blue line. Here we can see that over the last 10 years, this blue line has decreased quite a bit. A decrease in the blue line means that the CapEx actually has increased here. And over here we can see the scale of this. So today, NextEra Energy is investing more money than they ever have over the last 10 years. And basically this is only natural if you look at the long-term strategy to switch all their conventional energy productions to renewable energy productions. I also plotted here the total current assets and the total liabilities, which is the pink and the orange line. And what we can see here is that with the increase in the liabilities, pink line, the total assets also have increased at roughly the same level. So to me, this really shows that NextEra Energy is taking on debt, but they are taking on this debt to increase their assets, to build up these renewable energy parks, to profit from it in the future. Over the last decade or so, this also was a very good strategy because the interest rates have been very low. So one of the major concerns of many investors today is that with these increased interest rates, this amount of total liabilities of NextEra Energy could become a problem because the general expectation is that this increase in liabilities also increases the payments of interest rates for NextEra Energy, right? When we dig a bit deeper into these numbers, and here I plotted the interest expenses and the capex against each other, both lines show a downtrend, which is actually an increase in capex spending and an increase in interest rate expenses. And here we can actually see that the interest rate expenses over the last 2 years were very low, and even as of today, we are sitting just a little bit higher compared to the time frame of around 2020. Even though the interest rates compared to 2020 are quite a bit higher today. Of course, there is still the danger that these interest rate expenses will increase over the next couple of years, but this also depends on the level of interest rate that we will have then. And the expectation as of today actually is that the interest rate over the year 2024 will decrease again. Of course, the exact time frame when this will happen is not clear, but at least if we look at the next 2 or 3 years, my expectation is very strongly that the interest rates will come down from the current levels again. Maybe not to the very low levels that we had in the last decade, but still, it will be lower than what we have as of today. So my opinion is that this danger of increased interest expenses for NextEra Energy is not as high as many investors make it out to be. To emphasize this again, I want to show one more slide from the last company report, and here we can actually see that the balance sheet and the credit rating for NextEra Energy is still on a very good level. Standard & Poor's gives them an A-, Moody's gives them a Baa1, and Fitch also gives them an A-. These are still investment-grade credit ratings, and it seems like these rating companies agree with my assessment and don't think that this increased interest rates will be a problem for NextEra Energy over the next years. Especially when we again take into account the essential nature of their revenues and of their cash flows. It is very predictable and very stable. So it is very easy for the company to plan this ahead of time. When we sum this up by using my checklist, the revenue growth of the last 5 years have been sitting at a comfortable 11%, which easily beats my target of 6%. So green checkbox for me. The net income growth over the last 5 years only set at 2%, which is quite low and quite a bit below my target of 10%. The reason for this actually is that the net income 5 years ago in 2018 was sitting at quite a high level, and it came down for 2 or 3 years after this high level again. When we extend our time frame a bit and look at the last 10 years, the net income growth actually set at a CAGR of over 14%. So over the long run, NextEra Energy still could grow the net income with quite a good annual growth rate. So even though my checkbox here is actually red, I am not concerned about this because the long-term trend as well as the year-over-year value sits still at quite a comfortable and quite a high level actually. Instead of the free cash flow growth, as explained earlier, today we look at the cash flow from operations, and here we set above 11% compared to my target of 6% on the 5-year basis. So green checkbox again. The debt to EBITDA ratio currently sits at 4.5 times, which is a bit higher compared to my target of 3 times debt to EBITDA. So first of all, yellow checkbox for me. But in case of utility companies, this is nothing special. The high capex requirements in this sector usually makes these utility and especially energy stocks a bit more leveraged compared to other types of companies. Also, yellow checkbox for me because it beats my threshold, but again, I am not concerned about the current debt level of NextEra Energy. The dividend yield sits at 3.3% right now, and the dividend increase over the last 5 years set at 11% CAGR. So this is a very nice combination between quite high dividend yield and a very nice high dividend growth rate. We also saw that the margins over the last couple of years had a general uptrend. They have generally increased. So also this is a green checkbox for me. One thing I want to remark about the dividends here. We saw that the free cash flow is negative of the whole time period of the last 10 years. So that means also that the dividend have been paid by issuing more debt to the company. And what is not mentioned here in my summary is that actually the share dilution also set at a plus 1.4% CAGR of the last 5 years. So that means that NextEra Energy not only has issued new debt, they also have diluted their shareholders, which is not a very nice trend to see as an investor. I don't think that the dividend is in any danger of a dividend cut here, but I also don't think that this huge growth of 11% will continue to be at this level, at least when we look at the longer time frame of 10 years and plus. My expectation would be that this dividend growth over the long run comes down to a more reasonable level, maybe like 7 or 6% or so. Before we sum this up and come to our conclusion, let's also look at the valuation. And if you look at these multiples, EV to EBIT, price to cash flow, and PE, over the time frame of 5 years, all of these multiples are sitting either at the lowest level over this time frame or very close to the lowest level in case of the PE ratio. For sure, all of them are sitting quite a bit below their 5-year average. So compared to its own history, it seems like NextEra Energy is trading at quite a cheap level right now. As a dividend company, I also like to look at the dividend yield. And here I choose the time frame of 10 years. And over this time frame, the dividend yield was mostly sitting between 3 and 2%. In 2016, we had a couple of times where it was slightly above 3%, but in these last 10 years, we never had these high levels of around 3.3% dividend yield. So this is, again, an indicator that NextEra Energy might be quite cheap right now. For my fair value calculation, I excluded the discounted cash flow model in this case because the cash flow, as we saw, has been negative for the last 10 years. Instead, I chose to use the multiples calculation and also the Gordon growth model to estimate the fair value based on the dividends. And the assumptions I made is that the net income growth rate for the next years sits at around 8%, which is actually the company expectation. And I also used the PE multiple of 20, which actually is higher than the PE that we have today, but it's still quite a bit below their 5-year average. For the Gordon growth model, I assumed a long-term dividend growth rate of 6.5%. As I just mentioned, I don't think that they can keep this huge 11% dividend growth rate over the long run. So I'd rather use the a bit more conservative estimation, and in this case, I chose to use 6.5%. And if you look over here, we can see that with these assumptions, my average fair value sits at above $75 US, and with including my margin of safety of 20%, we come down to a fair value of around $60.5 US. The current stock price sits a bit above 57, So it seems like there's a little bit of upside compared to my fair value even when including the margin of safety. Because I cannot use the discounted cash flow model in this case, and my fair value calculation is only based on this multiple and Gordon growth model calculation, I also choose to look at the analyst expectations and the analyst price target. Here we can see that from 21 analysts in the last 90 days, 17 of them actually give a buy or strong buy signal, and only one of them gives us a sell signal. The average price target of these analysts also sits at a little bit above $70 US, with the lowest point being 46 and the highest point being 84. So the average price target of the analysts also sees a 23% upside compared to the current stock price. NextEra Energy has been a staple for many dividend investors in the past. Their unique combination between high dividend growth and a good yield make it a unique investment overall, and especially in the utility sector. But over the last year, the significant amount of debt combined with the fast increase in interest rate made quite some headwinds for the company. The trend of the company to keep investing and further increase the debt, while at the same time also increasing the dividend, led many investors, including me actually, question the management. But on closer look, the situation doesn't seem as bad as on first glance. Even though the free cash flow has been negative for the last decade, the operating cash flow is increasing faster than ever. And this also helps to bring the debt to EBITDA leverage even down a bit. And the interest payments on the debt are also on the same level as in 2020. But not only did they increase the total amount of debt, in addition, they also issued new shares, which diluted their shareholders. But this is quite a common practice in the utility sector to help fund their investments. One additional risk that I definitely want to mention here is that most of their assets are located in Florida. There is definitely the risk of natural disasters, namely hurricanes, that could affect their operation and also their assets. NextEra Energy actually has a unique position in the energy sector, as they are still operating conventional power plants while pushing at the same time their investments to renewable energies even further. These investments make up most of the capex of the company, and their assets actually increase at almost the same rates as their capex spending. The valuation right now is very reasonable. In fact, the shares of NextEra Energy trade on the lower side of their 10-year valuation and quite a bit below the average. My fair value calculation also gives some room for error, as the fair value seems to be quite a bit above the current valuation. So I think that at the current valuation, NextEra Energy is actually a good addition to any dividend portfolio, and especially if you are looking to diversify your portfolio to utilities, NextEra Energy is a very good pick in my eyes. But please, take my analysis with a grain of salt. I am already invested in NextEra Energy, so my view of the company is definitely a bit biased. So please, do your own analysis and double check my thesis before investing in NextEra Energy. So if you did like this video and if you did find my analysis helpful, please smash the like button and subscribe to my channel. Also, I'd be very happy to read your comments down in the comment section below. That being said, thank you so much for watching, guys, and see you in the next video.